Hi, welcome to In Conversation. I'm Marco Fantozzi, investment analyst in the research team here at Pitcher Partners Investment Services. Value investing started back in the early 20th century when Benjamin Graham, referred to as the father of value investing, laid the groundwork for this philosophy. One of his disciples, Warren Buffett, popularized this style of investing. Today, I, along with Warryn Robertson from Lazzard Asset Management, delve a little deeper into this type of investing strategy and how it differs from others. Let's have a look. Warren, thank you very much for joining us today.
Marco, pleasure to be here.
So let's start from the very beginning. What is value investing?
Value investing at its heart is essentially looking at a company and saying, this is what I believe its earnings or its cash flow is, and this is what I believe the multiple I should put on those earnings or the discount rate I should put on that cash flow to come up with an intrinsic value. And value investing is all about doing a whole bunch of that multiple times for different companies and finding the ones that are trading below those values. And essentially what you're doing then is to try and generate excess returns by buying a stock that's trading below its intrinsic value.
And so what are the key differences to, say, a value investing strategy to a growth investing strategy?
So growth investors will typically be looking for companies that are growing faster than their peers or faster than the market. And so they're fixated on businesses that are in that growth, are growing. A value investor equally will still look at growth companies, but will also look at companies that aren't growing faster than their peers. They may be in a very stable, predictable type of business. They may have a large market position in that particular industry that's not growing quite as fast. So value investing opens you up to a wider opportunity set than potentially what growth investing does. But a growth investor is primarily focused on how fast the company is growing.
And can you expand on some of the benefits of value investing?
Because value investing typically is looking at companies that are producing cash and generating earnings today, what you tend to find is they have a high dividend yield. So as an investor with a value fund, what you'll find is that you'll get a lot more of your return out of income or dividend than you would in a growth fund. The other benefits of value investing is typically because they're looking at businesses that are trading below their intrinsic value on what are low multiples or high yields. They tend to be more defensive. So when markets go through adjustment phases and markets become difficult, then what you tend to find is value investing does well in those types of environments.
Conversely, what are some of the potential risks of this type of investing?
Sure. I had it explained to me once, the risk is more relative than absolute. And what they mean by that is that essentially in markets are going very well and markets are up 25, 30%, your value investor is typically going to be falling behind the market in that sort of environment. Likewise, the other main issue for value investing is the issue of what they call value traps.
What is a value trap?
What they are is essentially when you believe that a business was worth, say, $4 and it ends up only being worth $2. Now, why that would be the case is essentially that you're dealing in a business that is either cyclical in its earnings outlook, and so you've got commodity prices, or you're a business that's a steel manufacturer and so commodities have moved around and against you, or you're in a very competitive market environment. Those types of businesses where essentially you've got multiple players, maybe potentially hundreds, that are competing for the customer. They're the businesses that are much harder to value. And of course, the value trap there is that essentially you thought there was a level of earnings that was sort of at this level, but because of the cycle or because of competitive market forces, it's lower. And then you can get caught in what's called a value trap. And essentially that keeps itching away at what you thought was a value of $4 may end up being $2, and you started buying it at $3, and you lose money.
Okay. So then how would you avoid a value trap?
Yeah, so essentially it's the Achilles heel of value management, and so you're trying to avoid it. And the way we've sought to do that, in the way we've structured our strategy, is to define businesses and to only look to invest in businesses that we define as economic franchises. And so these are businesses that produce predictable earnings throughout market cycles. They tend to be market leaders. They tend to have high return on assets. And essentially what you're doing is you're eliminating any of those cyclical elements. So we don't invest in oil companies or miners. You're also investing in non-competitive businesses. So you're not investing in the 10th or 12th or 20th player in a particular industry. You're really only focusing on the top one or two players in any given industry. And we think that the combination of non-cyclical earnings as well as market-leading positions in combination will eliminate all, if not all, then most of the chances of investing in a value trap.
Thank you. Just to change to a different topic, when you're looking at a company, what are the metrics or indicators you use to value a company?
What you tend to find is that you'll be looking at, as I said, a series of forecastable earnings, and you'll need to put a multiple on that. So value investors, I should say, typically have lower PEs or lower EBIT multiples than the market generally, because they're looking to find those opportunities that are trading below where they should be. They'll also have high dividend yields. They typically are highly free cash flow generative, so higher free cash flow yields. And that's where a lot of your return in the initial couple of years would come from, is higher dividend than opposed to a growth manager. So they're typically the metrics that you would see with a value guy. Low PE, lower EBIT multiples, high dividend yield, high free cash flow yield.
And you mentioned earlier intrinsic value. What is that, just to sort of give us a quick summation of that?
Sure. It's a nebulous term that should be really tangible. Essentially, it's essentially saying that a business will generate a level of earnings or a series of cash flows. And what you're then saying is, what is the multiple I should put on that earnings? Or what's the discount rate I put on those cash flows to come up with what is the true intrinsic value of that business? What is that business worth, not in a great year or a bad year, but in a normal year? And what would be the price that I would pay for that business if I was happy to own it forever? And then what you're trying to do is to find them where they're trading below that. Because essentially then what you're doing is you're adjusting for the excess returns that are coming back to that intrinsic value. And that's the fixation of a value investor. Trying to define what a business's intrinsic value is and finding those opportunities that are trading below it with what they call a margin of safety or conservative set of assumptions. And then, as long as you're patient, you're more likely than not to generate excess returns for investors.
Thank you. And you alluded to how you would measure intrinsic value. Could you expand on what are the things you look at when measuring an intrinsic value?
You'll typically find for an intrinsic value of a company, you'll be saying, well, what is the appropriate price-earnings ratio or PE? What is the appropriate EBIT multiple? And for a value investor, they're typically going to be below where the market's same measures are. Likewise, you'll be looking at dividend yield. How much cash is this company able to pay out to me, because it doesn't need to retain as much, because it's potentially not needs that for growth. So they're the types of metrics that you would find for value guys. You'll be looking for price earnings ratios. You're looking for strong dividend yields, high free cash flow yields.
And are there any particular periods where value investing does better than other strategies?
Just as, when markets do really well, value investing might lag. When markets are finding it tough, an adjustment phase in the market. So when we saw interest rates very recently move from their historical very low levels to more normal or slightly above normal levels, that was a good period for value investing. So when you see the market go through a state of flux, when they start to question, if you want, the long term, and they start to focus on what's the near term and what's closer to them, that's when value investing tends to do quite well. And then over a normal investment cycle, I would think over 10 years, you'll tend to find value investing will do very well in 3 years, it'll do okay in 4 years, and for 3 years it might lag a growth investor. That would be the typical way to think about it as an owner of multi-managers.
And you mentioned interest rates. Are there any other economic factors or situations that would impact value investing?
Absolutely. So as I said, as interest rates have moved back, you've seen value investing come back to the fore. Likewise, when recessions hit, your classic investment value investor will struggle in the early stages of an economic downturn. The reason for that primarily is that they invest in cyclical businesses that are price takers, so steel companies or commodity plays, or they're in competitive market forces. And when the economy does start to turn down, those competitive businesses there could be many hundreds of them, will start to try and compete much more stronger and undercut each other. So those types of environments, that early stage of a market, of a recession, value investing tends to struggle. And likewise, when you see interest rates start to fall and investors are able to put a lot more faith into the future, value investing will tend to struggle in those types of environments as well.
Great. Well, thank you very much, Warryn, for coming down and chatting with us about value investing.
Always a pleasure. Thanks, Marco.
Thank you for watching. If you'd like to learn more, please reach out to one of the advisors at Pitcher Partners, or feel free to explore our website.